Despite the current bear market and whether you like it or not, it seems that cryptocurrencies are here to stay. And I say currencies because that's the term, but they act more like commodities. What is interesting to me are stablecoins. They're currencies that hold their value. They're usually pegged to the US dollar and are meant to act essentially as digital money. Built on ideas of decentralization, resilience, low cost of transaction. Great stuff. Well, as of yesterday, TerraUSD, one of the largest stablecoins in the world, worth $18 billion at its peak, lost its peg to the US dollar, sending a shockwave through the crypto space, wiping billions in value. So, in today's video, how stable are these stablecoins and what is money anyway? Let's start from the basics. What is an algorithmic stablecoin? It's a digital currency that's supposed to always hold its value. It's usually pegged to a real world currency like the US dollar. So, unlike Bitcoin, for example, it'll be worth $1 and interchangeable with it. Only it'll be digital. Let's assume you're someone who wants to build something like this. Where do you start? You start by making two cryptocurrencies. One of them is the stablecoin and you call it Terra or TerraUSD. The other one is not a stablecoin and you call it Luna. Mind that these are just numbers on the blockchain at this point with no value. So to create value, you want people to buy them. Luna's value will be decided by the market through the laws of demand and supply. How do you turn something worth zero into something worth not zero? Marketing. You promise people exciting things built upon your token and promise them rewards for getting involved. As soon as there's some non-zero value to Luna, you're good to go. You can now tell people that they can always exchange Terra for $1 worth of Luna. Let's say Luna is trading at 10 cents. 1 Terra should get you about 10 Luna. And if it is trading at $100, 1 Terra should get you 0.01 Luna. Remember that the price of Luna is not fixed. It's decided by the market. But you have decided that 1 Terra will always get you $1 worth of Luna. You've set up this rule to work through a smart contract on the blockchain so people can do these Terra to Luna conversions and inverse. So how does this ensure that Terra will always hold $1 worth of value? And the answer is arbitrage. If Terra's value goes above the dollar value, people can buy $1 worth of Luna and exchange it for 1 Terra, which is worth more than $1, taking the profit. If its value goes below $1, people can buy this cheaper Terra and exchange it for $1 worth of Luna, making a profit. These arbitrage trades push the price of Terra and ensure that it always stays at $1. The price of Luna is not fixed, and as more people get involved in this newly created twin currency Terra Luna ecosystem, it will go up. But it doesn't change its stabilizing effects. Any non-zero value of Luna will continue to stabilize the value of Terra. Now all of this sounds great. When I first heard about the system, I was honestly quite impressed by the technological solution to value creation. How ingenious, I said. Well, the most important part here is actually not the technology. It's making people believe that the value of Luna is non-zero. It all hinges upon that. And as it turns out, you're in luck with this system. In the crypto world, people are making projects every day and getting millions of dollars. How will you do this? When people change Terra for Luna or vice versa, you can charge them a small fee. You can use this money to pay people to hold Luna as interest. This is called staking, or you can pay this money out as interest on Terra. I actually want to highlight this point because it's a big part of why people were invested in Terra. If you lent your Terra on the Anchor protocol, which basically acted as a bank, you were promised 20% returns on it. Imagine that, 20% returns on your money in this economy. How'd they do that? Mostly venture capital money. They subsidized what the market was paying. It's clearly unsustainable and they know that. Even many of the lenders know that. All they wanted was the ecosystem to grow to a critical mass where Terra becomes, well, real money. Real money used by everyday people, or at least a lot of people. A consequence of this is that Luna's value shoots up. The VCs can then make their profit and they can stop subsidizing lending. And this is the key here. Ecosystem. Luna is worth something because of people believing in it and being involved in it. There are a lot of people building applications and systems that use Luna, and when people see this big visible ecosystem, they value it more. So, when we call it an algorithmic stablecoin, it's good to remember that the stability comes from the twin token relationship, but the value comes from people's belief in it, and people's belief in its future. People can wake up one day and just stop believing. If they start to sell their Luna, the price of Luna goes down, and if they start to sell the stablecoin Terra, you think that the downward pressure on the price will be alleviated by the arbitrage. But remember that the arbitrage only works when people also believe in Luna. Well, as it turns out, surprising no one, people can lose belief in both currencies and decide to sell both Terra and Luna. Someone will sell Terra, driving the price down, resulting in people buying it cheaper and exchanging it for Luna. But people are already selling Luna and its price is also going down. And there's nothing that will stop it. You'll reach a point where 1 Terra will give you 10,000 Luna, with each being worth $0.0001 US. You then try to sell the Luna, but there's no one to buy it from you. Liquidity has dried up. Now when Terra's price faces a downward pressure, no one will try to arbitrage it because the lack of Luna buyers. They'll directly sell their Terra holdings. What this will do is allow Terra's price to fall down, depegging it from the dollar, which will eventually lead to everyone giving up on the stablecoin because it's not stable anymore. All the digital infrastructure, all of the ecosystem, which was really the store of value, becomes worthless without people's trust. This is called a death spiral. They have a name for it because it works the same way in traditional finance. What's funny here is that people in crypto are building the same stuff. They're starting from first principles, but they're ending up in the same place. Both Terra and Luna have lost almost 99% of their value in a week. Why did this happen? The market either predicted, caused, or bet on a death spiral. And Matt Levine has written a great blog about it, which I'll recommend you read. But it's a funny thing about markets that they just do this stuff sometimes. There are a lot of conspiracy theories about who caused it, which we won't get into. But it's bad. People have lost their life savings invested in this project. If you go to the Terra subreddit, they have a suicide prevention helpline. Pinned. Do Kwon, the creator of this project, he had posted about plans to repeg Terra back to $1. But he hasn't posted anything in a day now. And there are a lot of news reports about how he was also one of the people who led another similar failure in the stablecoin business. It's grim stuff. We are talking about this topic today because there are predictions that crypto will become much more integrated with the world economy as time goes by. And such failures could destabilize it. So it's good to understand it. The second thing was that the whole Terra Luna relationship was just very intriguing to me. But most of all, I'm very interested in understanding what gives things value. It's good to think about and know what gives a regular currency value. There's no inherent value in US dollars. They're pieces of paper or numbers in a ledger. Before the early 1930s in the US, there was what was called the gold standard. The money used by everyday people was backed by precious metal. There was, for example, a fixed price of gold, and that was used to determine the value of currency. But starting in the early 30s in the US, FDR, through a series of actions, moved the US away from the standard. The gold standard was understood to be like the natural law of the world. People were afraid of this transition, and they were thinking that this would completely destroy the Western civilization. Remember that this was the time of the Great Depression. Trying something this radical amidst such an economic crisis was unthinkable. Well, today there's a consensus amongst economic historians that abandoning the gold standard gave the government the tools required to come out of that crisis. This example is meant to illustrate how so much of what we consider to be set in stone, or the way it has to be, is incorrect. Our institutions are malleable and they can be adapted depending on the circumstances. Today's fiat money is valuable because of how integrated it is in society, because of its now long history, and in the case of the US dollar, it is backed by the might of the American economy. Even commodities like Bitcoin have a non-zero value because of the belief in it. They're all houses of cards. Some fall, others don't. Incidents like these are a good reminder that while the critique of institutions is important, there's tremendous value in building structures of trust. As we together build our future, knowing this is going to be more important than ever. Thanks for watching this video. If you enjoyed it, give it a thumbs up. Subscribe and turn on the notification bell to see more videos where we dive deep into ideas that need a closer look. Let me know what you think about cryptocurrencies in the comments. Do you think there's any value in building such alternative systems? And until next time, have a good one.